Welcome back. Today we're revealing 3 business tax hacks for 2025 your CPA probably won't mention. Most CPAs stick to standard deductions. They're busy and creative strategies often get overlooked. But these are the legal, ethical moves that can save you thousands and free up cash for your business or investments. I'll break down each hack step by step so you can discuss them confidently with your accountant. Stick around for a bonus tip at the end that could be a total game changer. Grab a notepad, let's dive in. Let's dive into the home office deduction, a frequently overlooked but incredibly valuable tax benefit for business owners and self-employed individuals. It's surprising how many people leave money on the table here, missing out on significant tax savings simply because they're not aware of the rules or don't think they qualify. We're here to change that. The IRS has specific requirements to ensure that only legitimate business expenses are deducted. The 2 key requirements are exclusive and regular use. Let's break down what that means. To qualify, your office space must be dedicated solely to your business and used consistently. This means the area should only be used for business activities. Think of it as a mini headquarters within your home. The good news is, even a partitioned section of a room counts, offering flexibility for those without a spare room. The key is that the designated area is clearly defined and used exclusively for business purposes. As long as it's not used for anything else, like a guest bedroom or a play area, you're on the right track. Here's another important point. Your home office can qualify as your principal place of business, even if you work elsewhere, like at client sites or co-working spaces. This is particularly relevant if you handle key administrative or management tasks for your business from your home office. As long as you handle key admin tasks there, you're in good shape. Now let's talk about how you can actually calculate the deduction. There are 2 deduction methods available to you. First, there's the simplified method, which offers a straightforward calculation, but it's capped at $1,500. This is a good option for those who want a quick and easy calculation. Then there's the regular method, which, while more complex, can yield much bigger savings, especially if you have significant home-related expenses. With the regular method, you'll need to calculate your office's percentage of your home's total square footage. This percentage is crucial because it determines how much of your home expenses you can deduct. Once you have that percentage, you can deduct that percentage of expenses like mortgage interest, rent, if you're a renter, utilities such as electricity and gas, homeowner's insurance, and necessary repairs to your home. Don't forget other eligible expenses like HOA fees, and even the cost of cleaning services for your home. In addition to these indirect expenses, you can also deduct direct expenses, like painting your office to create a more productive workspace, or buying a new desk and chair specifically for your business. These direct expenses are particularly beneficial because they are 100% deductible, providing a significant tax benefit. To make the most of this deduction, it's essential to keep meticulous records. Save all relevant bills, receipts, and invoices related to your home and business expenses. It's also a good idea to take photos of your office setup each year. This provides visual documentation of your dedicated workspace. When claiming the deduction, be honest and don't overreach. Only claim space that is genuinely used exclusively for business. Accuracy is key, so document everything thoroughly and keep it organized. To avoid a last-minute scramble at tax time, track expenses monthly. This will make the process much smoother and less stressful. One of the most significant benefits of the regular method is that it also lets you depreciate the business use portion of your home. Depreciation is a non-cash deduction, meaning it doesn't involve an actual cash outlay, but it allows you to deduct a portion of your home's value over time, adding up to substantial savings. To recap, make sure you're using a dedicated space exclusively for business, and carefully consider whether the regular method could unlock bigger savings for you. Remember to track both direct and indirect expenses meticulously, and keep bulletproof records to support your deduction. By following these steps, you can transform a basic deduction into a powerful tax-saving tool that significantly reduces your tax liability. Don't let fear of paperwork stop you from claiming what you're entitled to. Your future self will definitely thank you for the effort. If you're not actively maximizing this deduction, you're essentially leaving money on the table that could be reinvested in your business or used for personal savings. To ensure you're taking the right approach, talk to your CPA or a qualified tax professional about which method fits your specific situation best. Remember, the IRS rewards those who are diligent in their record keeping and who play by the rules, so accuracy and transparency are key. It's important to remember that the home office deduction isn't just for remote workers who are employed by a company. It's a valuable tool for any business owner, freelancer, or entrepreneur who regularly manages key tasks and responsibilities from a designated home office. So, get organized, develop a strategic approach to tracking your expenses, and watch your tax bill shrink as a result of this powerful deduction. That's how you can effectively turn your home into a significant tax advantage, boosting your bottom line and freeing up capital for other ventures. Now that we've unlocked the secrets of the home office deduction, let's move on to the next tax hack and discover even more ways to optimize your financial strategy. Next up, Section 179. This is a provision in the tax code that can be a game changer for businesses of all sizes. It's all about how you handle the costs of equipment and other assets you acquire to run your business. This is the secret weapon for anyone buying business equipment. It's a powerful tool that allows you to write off the full purchase price of qualifying assets in the year they are placed in service. Instead of depreciating equipment over years, which spreads the deduction out over the asset's useful life, Section 179 lets you deduct the full purchase price in the year you buy and use it. This can result in significant tax savings and a much faster return on your investment. That means a $10,000 computer or camera, or even a piece of machinery, can slash your taxable income immediately. This reduces the amount of tax you owe, freeing up cash for other business needs. Qualifying items include machinery, which is great for manufacturing and construction businesses, computers, essential for nearly every modern business, office furniture, making your workspace functional and comfortable, vehicles, used for transportation and deliveries, and even off-the-shelf software. This covers a wide range of tools that businesses rely on daily. The equipment must be used over 50% for business. This ensures that the deduction is primarily benefiting business activities, not personal use. For 2024, you can expense up to $1,220,000, providing a substantial opportunity for tax savings, with a phase-out starting at $3,050,000 in purchases, meaning the deduction gradually decreases as your total purchases exceed this amount. Plenty for most small businesses. It's designed to help them grow and invest in their operations. This isn't just for new gear. Used equipment qualifies too, expanding the possibilities for businesses on a budget, as long as it's new to you. The equipment simply needs to be new to your business, not necessarily brand new. You can even finance the purchase using loans or other financing options, and still take the full deduction, making it easier to acquire necessary equipment without a large upfront cash outlay, maximizing cash flow. This is crucial for managing day-to-day operations and investing in future growth. Section 179 can't create a business loss. There are limits to prevent this. Your deduction is capped at your net business income, ensuring you don't deduct more than you actually earned, but unused amounts carry forward. This allows you to use the remaining deduction in future years when your income may be higher. Vehicles have special rules. It's important to understand these nuances. Heavy SUVs and trucks, over 6,000 pounds, often used for business purposes, can qualify for much larger deductions. This is due to their classification under IRS guidelines. Plan purchases strategically. Timing is everything when it comes to tax benefits. Buying before year-end can offset a high-income year. This can significantly reduce your tax liability for that year. If your income is low, and you don't need the deduction immediately, you might defer the deduction for future years. This allows you to take the deduction when it will provide the most benefit. Don't overlook software. It's an often missed opportunity for deductions. Subscriptions like Adobe, used by creative professionals, or Microsoft Office often qualify. These are essential tools for many businesses. Section 179 is about timing and planning. It's a strategic tool, not just spending. It's about making smart investments that benefit your business and your tax situation. Talk to your CPA before big purchases. They can help you navigate the complexities to maximize your benefit. Professional advice is invaluable in making the most of this deduction. This hack turns necessary expenses, things you need to buy anyway, into powerful tax shields. It's a way to protect your income and reduce your tax burden. Use it wisely with careful planning and consideration, and you'll keep more cash in your business. This allows you to reinvest in your company and fuel future growth. Ready for the final hack? Let's dive into another strategy to help you optimize your business finances. Now, for the last but certainly not least tax-saving hack, hire your family, especially your kids. This is a strategy that can provide significant benefits, both financially and in terms of family development. It's completely legal, IRS approved, and can be a huge tax saver when implemented correctly. Many business owners overlook this simple yet effective strategy. Here's how it works in a nutshell. You pay your child a reasonable wage for real, actual work that they perform in your business. This isn't about creating make-believe jobs, it's about identifying legitimate tasks. For 2024, each child can earn up to $14,600 completely tax-free. This is thanks to the standard deduction, a provision in the tax code designed to help lower-income individuals. The standard deduction. This means that your child won't owe any federal income tax on earnings up to that amount. And here's the kicker. You, as the business owner, get to deduct their wages as a business expense, which directly lowers your taxable income. It's a double win. If you're in, say, a 24% tax bracket, that translates to over $3,500 in federal tax savings per child just from this deduction alone. And that's not even counting any potential state tax savings you might also receive. The benefits can really add up. Now, if your business is structured as a sole proprietorship or a partnership with your spouse, there's even more good news. In these cases, wages paid to your kids who are under 18 are completely exempt from Social Security, Medicare, and federal unemployment taxes. That's an extra 15.3% in payroll tax savings that you get to keep in your business. It's a significant advantage. Of course, the work your child performs must be legitimate. Think of those essential office tasks, managing your social media presence, keeping the office clean and organized, or even modeling for your business's marketing materials. It's crucial to document everything meticulously. Create clear job descriptions, maintain accurate timesheets, keep detailed records of paychecks issued, and the specific tasks that were performed by your child. And remember to pay them like any other employee. No cash payments under the table. Everything needs to be above board. Encourage and help your child open a Roth IRA with their hard-earned earnings. Contributions of up to $7,000 per year can grow tax-free for the rest of their life. The power of compounding is incredible. This isn't just a clever tax move, it's a fantastic way to teach your children about financial literacy and start building generational wealth for your family. You can also consider hiring your spouse in your business, which can significantly boost your retirement contributions, although standard payroll taxes will apply in this case. It's paramount to always pay reasonable wages that align with the work performed and to keep thorough, accurate records to satisfy any potential IRS inquiries. Now, if your business is structured as an S Corp or a C Corp, standard payroll taxes will apply to your kids' wages, so it's always a good idea to double-check with your CPA to ensure compliance. Avoid being informal in your approach. Treat your family hires with the same level of professionalism and formality as you would any other employee. Ultimately, this strategy is about keeping money within your family, significantly slashing your overall tax bill, and setting your kids up for a brighter and more secure financial future. It's an investment in their long-term well-being. Take some time to carefully review your business operations for tasks that your family members can realistically perform, and always run your plan by your trusted tax professional for personalized guidance. It's truly a win-win strategy, benefiting both your business's bottom line and your family's long-term financial future. All right, let's wrap up this section and move on to the next key strategy. There you have it, 3 tax hacks that can seriously cut your tax bill in 2025. Maximize your home office deduction, leverage Section 179 for big purchases, and hire your family to keep more money in-house. These are IRS-approved strategies, but always consult a qualified tax professional before making changes. Use this video to start a smarter conversation with your advisor. If you found value, hit like and subscribe for more tips. Drop your questions or tax tips in the comments below. Thanks for watching. See you next time.